Okay, let's get started. Okay, let's do it. Well, thank you so much all for attending. And if you are coming in a little bit late or weren't able to watch this, you can feel free to watch a replay of this on YouTube. I'll give you the link later on. This will be recorded and you can always check it out that way. So let's talk about this. October, where we're at right now, almost to Halloween time, renting versus buying seminar here in the Bay Area. What should you be doing? What are things that you should be considering whether right now is the right time for you to rent or to buy? We're going to first start off with a little bit of my background. It's important to know who you're even listening to. So a little bit about me. I'm born and raised in the San Francisco Bay Area. Been here my entire life. Love the Bay Area. I do travel all over the world. I have a few trips coming up myself, but it's always nice to call the Bay Area home, especially if you're in specific industries more than anything else. And we're going to talk about that because those are key drivers of what is still happening today. Regardless of all the different things that are happening from the public and the news, certain things are still happening and they continue to happen if you look at it more closely. A little bit about me. My first decade of my career, I was in technology sales. I did a lot of things related to corporate real estate space for a long, long time. Because of that background, I got to understand why are companies growing in a certain way. Right now, with the most flexibility in history, they are still growing in a certain way. Why is that? And we're going to talk about that because it's extremely important for areas like the Bay Area, like Seattle, some of these very prime tech-heavy areas. But we have several things that Seattle doesn't have, and we're going to talk about that later on. A little bit on us. I'm the owner and team leader of our group. This last year, we helped about 58 clients for about 73 million of transactions. We are fortunate to be in the top 1% in the country. So I appreciate all the support and continued support that we keep getting. So far, year to date, our team has helped already 67 clients. So we're going to end up doing significantly better than last year, regardless of, as I mentioned, all the different things that you're hearing. So let's jump into what is actually happening with the market and why are things happening, right? The most recent report is that inflation is still high. It has not been deterred at all much, even with all the continuous rates increases. And we're going to expect, and it's already been forecasted that we should get another 75 basis points probably by the Fed for the next 2. The question from there is what will happen next? These are already factored in. So the treasury yields, the mortgage rates, all of these things are already factored in of what they're expecting to do because there tend to be leading indicators. The question then is, at that stage, once those basically a few months goes by, will inflation start to decline or will remain the same, which means we will then have further increases in rates. At that point, it is a guessing game. There is no guarantee one way or another where it will go. But what has that meant? It meant that because rates are much higher, all assets have been impacted. Just be very open and look at your own accounts, right? Stock market, S&P is down 25% from its high, which was late December of last year. NASDAQ is down 35% from its highs, which was actually back in mid-November. Bitcoin and crypto, if you've been in it, it's been a rough beating. They're not a hedge against inflation, clearly. They're down more than 70%. So the question that you don't see out of all these different asset classes is, what about housing? What has been going on with housing? Now, housing is always a local market. The market of the Bay Area is different than Seattle, which is different than Texas, different than Florida. They all have their own situations happening. Now, because the Bay Area has been more tied to tech because of compensation, fortunately or unfortunately, depending on how you look at it, the market has actually declined some of the most relative to others in the country. And it will also decrease some of the earliest too, because we felt more of the pain, right? Think about even big tech, valuations have declined. Think about startups. I mean, startups, their valuation is cut significantly because the growth multiples are completely different. So they already had a bigger impact than other areas that that are more stable, that are just more consistent. So there's a difference of the job employment and how it impacts markets. Now, the question though, and people may have assumed, oh, just because interest rates are increasing means housing will decline. That's not a guarantee, because you can't argue for the fact that, as you can see, really the last 3 months have been relatively flat. Are interest rates higher than it was 3 months ago? The answer is yes. So you can't do a direct correlation, and that's a very important understanding and exercise of this. That is still supply and demand element of things, but there's no guarantee, because everybody thinks that just because rates are higher that prices gotta decline. No, they don't have to decline. They decline because of supply and demand, of whether the sellers need to sell or not, and whether buyers want to buy. But fortunately, they have declined for many people, especially as one gets in the market, by 13% so far since the highs of April. So is this as good or bad as you thought it would be? Right? Some people will say, look, I thought it would go more. There's a lot of complaints and a lot of people that think one thing, but when they see the data, the data speaks for itself. Now, the other thing that we hear is, what about transaction volume? So what happens with higher rates is a combination of things. The buyer pool is less, so that is a real thing that has happened. But at the same time, listings are also less, right? Because there's maybe less listings that come on the market, as people don't have to sell. They can just rent out their homes. And we're going to talk about the rental market in a bit. And so those are all material things. But is it as bad as people are saying it is? So this year, from the September numbers versus the highest point of the year, which is usually April, is about 26% less transactions. So number of sales is down 26%. That is why you hear so many things about all these layoffs related to real estate businesses. Compass doing massive layoffs. Wells Fargo, big banks are doing big layoffs. These small startups that have been money losing machines, they're doing massive layoffs. It makes sense, right? Because the volume is how the business of it works. Like if it's 26% less, they should be technically cutting at least 26% of their workforce, right? I mean, that's just the sheer volume of doing things is less. And that doesn't even determine if the business is healthy or not, right? Some of these companies like Compass, which has been losing hundreds of millions of dollars a year, and these other companies are having to do a lot of budget cuts because of the combination of their valuation is now slashed because of higher rates, but also because there's less business to go around. But the question that when I see these numbers is, I like to say, okay, well, if that's the case, what did last year look like? If you actually compare last year, as you can see, last September versus last April, that also was down 16%. So what that means is 16% is just part of regular seasonality. Now there's an extra 10% that's a drop for this year, but it's not as extreme as all the different things that you see. So it's very important just to get perspective. And that's why I'm showing you all these live data points, because you're going to be seeing all this information before the public media does it, because the public media is really behind with this kind of information. And then they got to do the story, run the story much later. So that's about that. Now, I don't want to say buying a house is always a good thing, because it's not. It's not for everybody. But it does rely on a few specific situations. And that's why I want to bring up first, because if you fall in line with these, then it doesn't make sense to buy. Then don't buy. Maybe there's another time that it does. So why is renting a good idea? Let's talk about that first. If someone is planning to leave the area within a couple of years, that is probably makes sense not to buy. I mean, if you're going to be gone in 1 or 2 years, or you're not really sure if this is the right spot for you, then don't buy. Rent, hopefully as cheap as possible. Enjoy life. When you settle down or decide where you want to be for at least a couple of years, then decide to make the move if it makes sense for you at that stage. Another one, I mean, there are some companies that are not doing as well as others. So some companies are still booming. We're going to talk about which ones are still booming right now. We're also going to be talking about there's many companies that are just not doing well. They may be going through layoffs. So if your company is going through some challenges right now, and you see layoffs, and it may be further layoffs, I think from a stability perspective, that's probably an opportunity or a situation where you probably don't want to buy, especially if you're in an industry where it's not that easy for you to land another job. So that's something to be mindful of. So I want to be very respectful of that. Some, quite frankly, maybe have a different thesis of investment opportunities. Some say, look, I want to just be really, really cash heavy so I can invest in these businesses, right? Like, think about my situation. I run a business too, a real estate business. I can use that money to buy homes. I can use that money to buy stocks. I can also use that money to invest in people in the business. And if I feel like the business can generate more returns than housing or whatever I'm thinking of, then that makes sense to do. Some people have different things going on that it may make more financial sense to invest in those things. So I totally get that. And the last one is a little bit similar to like the first one. I mean, there's some people that are still living the nomadic life. And so if you want to keep traveling, then this is probably a better idea just to rent it and go from there. Now, there is a cost for rent, right? At the end of the day, renting it's not a zero-sum game. It's not like you're renting and you're renting for free. Someone's giving you free rent. At the end of the day, the Bay Area is going to be some of the highest rental markets in the country. The average rent, as you can see in Santa Clara County, is over $3,000. That's just Santa Clara County, which encompasses a massive part, which is like San Jose. Now imagine, and you probably know, if you know of anybody that's renting Mountain View, Sunnyvale, those are significantly higher. There's a reason why those new construction are all luxury ones. They can range from $4,000 to $6,000 today, and they have zero issues finding people to pay for rent because it's a good location. It's a very, very nice unit, and people are still clearly earning a lot of money to be able to afford and want to afford that kind of luxury. So what is the state of renting? I think it's also important to understand this. If transaction volume is down by 27%, where did all those people go? They didn't leave the area. They end up renting a home. And so that's why you continue to see still today, rent prices continue to increase, because like that's a big pool of people that are not even thinking of buying a home anymore, right? So that's a very important thing to factor in, to be aware of. The other thing that's been very different of the Bay Area is think about the return to office side of things. In the last 2 years, people had the most flexibility in history. They can go anywhere. They can go to Florida. They can go to Texas. They can go anywhere they want. But now people are going back to the office because a lot of companies have already spent and committed to and prefer people to be back in the office. That's number one. Number two, people cannot have multiple jobs anymore. So a lot of companies understood this. Like now it's starting to swing the other way, where it was very, very easy and friendly for employees to be able to have multiple jobs. I personally know many people that have 2 or 3 engineering jobs at a time, just absolutely ridiculous. But now, as those have been tightening up, all this kind of shenanigans have been tightened up. These companies want people back in the office, especially like Apple, especially in biotech. We see this continue to happen. And so all those prime areas, all those good areas have continued to do well, especially when it comes to the rental side of things. Now, that gives you an idea of like the pros and cons, a little bit of the things to consider of like renting, the good and the bad of it, and things to consider. Let's talk a little bit about housing in the Bay Area, just so people have perspective. You can see what the general long-term overview of housing is of the San Francisco Bay Area, which are all the counties here, versus like just the general US. So we have a few things of why typically the long-term appreciation has been stronger than the rest of the country, even today, and even the forecast today. The reason is several, right? And we'll talk about that. The reason is we have quite frankly, some of the highest incomes in the country are here. We have a lot of companies that continue to still be building in the same areas, right? I mean, just look at the density. I mean, anybody that doesn't agree with it, just drive to Oyster Point, just drive to South San Francisco. Are they building new buildings or not? And then compare how many apartments have been being built in that area or just anywhere in the vicinity of that, right? Are there more office space than ever before, especially lab space? Like that's a huge driver. Look at still what's happening in Mountain View, in Sunnyvale, in Cupertino, in Santa Clara. how much office space are there for just those locations versus relative to how many actual apartments or never mind homes are being built. And so that's why you see some of these growth. It's like the reality is you have this aspect of high income, also an area where they are very focused on building consistently. And there's plenty of other things that you can still blame too, right? You may blame zoning laws. You can blame some NIMBYism, which is a real thing. I'm not disagreeing with that. But at the same time, there's also just geography issues, right? If all these companies still believe, and they do believe, that they need to be in these prime areas, primarily because the talent is in those areas, that's extremely important of how the appreciation works, why the demand still works in those areas. And those are very, very strong considerations to make and understand. The other thing that I've personally been seeing, because I'm very fortunate in my position to be able to have such a global perspective, like I have people from all over the world that have been reaching out to me, say, look, I'm going to be moving to the Bay Area. Yes, we may be renting first because we want to understand the area, but I got a job at Google. I got a job at these companies. We're going to rent for a year or 6 months or whatever it is, and then start looking for a home. But people are all over the country and all over the world have been moving continuously to the Bay Area for work and for these opportunities. When we hear reports of California losing people, that is a real thing. But it's always been losing people. Like the last 2 years has been more for a reason. One, a lot of flexibility of work, but also two, to be fair, everything was locked down because California historically has been a very big hub for people from all over the world to come to the Bay Area and to California. And so because that completely got shut down, outside talent couldn't go in, which is not good. That's not a positive thing, and hopefully things change. And at the same time, then people had flexibility, then they choose to leave somewhere else. Now, some people elect to maybe coming back. Other people from other places in the world are starting to open up, and so then now they're leaving. So that's just a reality of the nature of the Bay Area in California. We'll probably continue to see that happen. Is as long as the U.S. and California continue to be that destination for people and talents from the world, then they're going to naturally attract these great people, naturally attract high-paying jobs, naturally attract great companies, and those are all very important because let's talk about that. Look at this number: venture capital funding by region through the years. Last year and this year is actually very similar, if not worse. In California, $157 billion was invested in California-based companies. That is 3 times more than the second place state, which was New York. All this commotion about people moving to Texas and things like that, a lot of things that are happening in Texas tends to be more of those legacy players, legacy companies that cannot compete with these higher growth and just more ambitious companies. But look at that. It's 160 times what the venture capital investment is in a place like Texas, right? And so the reality is venture capital, while there's more opportunity for people all over, is still very, very dense in California and even more so in the Bay Area. What's another thing that people have not been talking about? Biotech has absolutely boomed in the Bay Area. South San Francisco in the Bay Area was not the #1 player for a long time. We have like San Diego, we have like Boston. They're huge players. And I know the ranking kind of keeps shifting, but the truth is, like biotech in general, South San Francisco is the major hub, but also just along the peninsula now. I mean, look at that Alexandria real estate, that building next to, I think it's in San Carlos or Redwood City by the highway. Like that's a brand new biotech facility that was instantly rented out. And there's still a very, very big demand of lab space. And this is very unique, right? These are not going to be fully remote jobs for those types of instruments and lab work and things like that and those opportunities. So because this whole sector of biology and technology with sequencing, with genomics, has continued to be creating so many opportunities and bets, we continue to see a lot of the talent from engineering, from all these traditional big tech into these other areas. A lot of my clients work in these industries. They do very well. The compensation is actually quite well. Their salaries and income it's actually not that far off against big tech. In the past, big tech was a little bit stronger because of the equity component of things. But now that that side is not as impactful because of valuations, it's going to be really, really interesting of what happens over the next couple of years for that reason. And I know many of you that are on this live seminar or watching on YouTube are in these industries. So it shows a little bit of like the very silent change, right? Because everybody just thinks of the Bay Area as the tech capital of the world, and it is. But that being said, there is this thing that has been very quietly becoming a huge driver and a huge player in the local ecosystem here. We're going to talk a little bit about the secret pluses of a home ownership that most people do not talk about, but we're also going to be talking about from a general analytical perspective too. Because at the end of the day, I'm a strong believer of just having a diverse portfolio, but also just understanding general metrics of historic returns, because it's incredibly important, right? So in general, for Bay Area real estate, which has done some of the highest in the country, is not like a crazy amount. The average return over several decades is about 5.5% to 7%. Single family does better than other asset classes. It also depends on the area, so this may range. S&P in general is about 7 to 9%. Just track back however long you want to track. You could run the numbers there. It's all also very public because that's just what it is out there. But the few benefits that you have with real estate as an asset classes is several. Number one, which is your capital gains exclusion. This is a very important because at the end of the day, these are your returns on paper, but when you sell it, I'm not a tax professional, so you always want to consult a CPA about it, but they can tell you the same things. Is at the end of the day, it's not just about what it returns for, but what you actually take home, right? And with real estate, if you've been a home owner for the last couple of years, 2 out of 5 years, you have this option, the ability to use this capital gains exclusion, which means if you're single, that's $250,000 in gains, or $500,000 for a married couple that are excluded from the capital gains tax, which is very, very important. So if you do the return post-tax, it's actually a lot more balanced out than you may think. That's number one. Number two, you have the option to use these things called leverage, and it's much cheaper leverage than if you're using like margin call, which is something that you have if you're like in your stock account. Think about this. If you want to double up, you're so bullish, I'm going to double up on the S&P because I know it's going to be having a big run. You can do a margin call today, which means you can get up to like 2x your money, but you'll be paying 9% these days to borrow against that. So unless you're in a sure bet, then that can work because you may not be making that bet for a long time. But for real estate, you have these aspects, they're loans provided by the banks and the government. That allows you to do basically more than 5 times leverage if you want, right? 5 times leverage is just simply 20% down. So it's a very powerful thing because then the return of the capital that you invest is actually could be significantly higher than just putting your cash in these other markets. That's very important for people to know about the secret pluses. The other things that are there, so we talked a little bit about the tax benefit side of things. There's also the secret benefits of like being able to cash out, refinance some of that equity without paying taxes, right? So if you actually had a lot of money that's tied to your home, you may elect to do these other ways to extract money out. You may then choose to allocate that however you would like. That's different than if you're like owning stocks and now you have to sell stocks. Now you have those gains, and that's a different thing to deal altogether. Some people want the convenience and stability of owning a home, especially as you have like life changes like kids or relationships that you want to be, like people you want to be around. That is very important. But the last thing that's very overlooked is being diversified from their current portfolio. There are so many clients that I deal with that a lot of their net worth is tied to the company stock that they are at, which is generally not a good thing, right? I mean, maybe very good in positive years, but it's not a diverse portfolio. So a lot of people have said, look, I am way too concentrated in this one company. I want to divest out of that one company. I want to divest out of the stock market. I want to have real estate as part of my portfolio of assets. So those are all important things. Now, there are cons of owning a house. This is not for everybody, and it's always important to understand these. Number one, this is not a liquid asset, right? Just because you want to sell it today doesn't mean you'll get your money tomorrow, right? That's not how it works. We got to prep it, we'll stage it, we'll get it out on the market, we'll get as much as possible, but there's a process of the time it takes to get involved. So generally, you shouldn't be thinking of real estate as something liquid and ready to just flip within a matter of a year or whatever it may be. You want to think about it as something that you hold on to longer. Next, there are property taxes. Now, there are many of it that is going to be tax deductible, but there's going to be property taxes that you'd be paying at least twice a year that you need to factor in terms of your overall expenses. Next, you may have repairs and maintenance. Now you are the one that has to budget for it and account for that appropriately, right? In the past, if you're a renter, then the landlord takes care of that. As a homeowner, it is your responsibility to look over that. Now, homeowners insurance, I'm going to put in there because that is an extra thing that you're going to have by requirement. Now, most people should have a renter's insurance, but many may not. But either way, now you'll have this as an additional item. So those are the cons to be aware of. Now, the question that I get a lot, and you can play around with your own rental calculators. There's so many out there. They all vary slightly. But generally, when I run it, and if you put in the right numbers, because you have to be you can't be like overly conservative of long-term appreciation when you just saw that over decades it's 5 to 7%. You can't be like, oh, I think it's going to be 0%. That's not how it works. You can be conservative, maybe put 4% or whatever it may be. And some people are doing the reverse. They're saying like rent never goes up. I'm going to put that at 0. And I'm going to really like make it better the other way. But truthfully, if you're putting it conservative numbers on both sides, typically it's, if you plan to be in an area for at least a few years, as in 3 years, it's going to be typically cheaper than renting as being a homeowner. So that's kind of the breakdown. It's also a very good number to know because if you actually look back at the data, and I don't have it here, unfortunately, but if you look back at the data of 2008's real estate recession, which is caused by a real estate bubble, by faulty lenders and just the shenanigans, it really took about 3 to 4 years to fully recover. And so that's why, like, it's also important, like, look, at the end of the day, you don't have a crystal ball. And the thing to be mindful of is you're still dealing with inflation. You still have to balance your portfolio. Is real estate doing better or worse as an investment than your other assets that you're in? But typically, it's within 3 years, it makes more sense to buy instead of rent. So now that we kind of shared a lot about buying, renting, whether it's right for you, you got to figure out yourself. I'm here to help. I'm happy to discuss options with you. But the key at the same time is when markets are on fire, there's a game plan for that. When markets have declined, and they are declining still, even though there's been fairly flattened recently, there are now changes and opportunities that there was not before. Because think about this, right? You have less transactions. Things are on the market longer. There's less buyers. So what does that mean if you are a buyer looking? You have more time to look at homes, right? Because things are not flying within one day. That's just not how it is anymore. They're still moving, potentially moving quickly, but they're not like instantly selling. You actually have less competition out there. So your buying experience is going to be more pleasant, relatively more pleasant. You're buying now these great assets, as you can see, of long-term history at a discount, which is extremely rare. Virtually, there's no appraisal risk, right? I mean, back just 7 months ago, you have to realize you're 20% down or whatever it may be. It may not be what you're actually putting in. You may have to account for that accordingly of putting more money down just in case. So if you're thinking of putting less money down, like a 3.5%, 5%, 10%, you actually would have had a lot more money as backup just in case it didn't appraise. So that risk was there because it's a rising market, right? If you look at homes, that's if in a rising market, if you're buying a home at this time, if they look at previous home sold, they're looking back here. So there's a gap that you need to fill with extra capital, right? That's a very important thing that people don't realize that that's different. In a down market, if you buy here, all the homes that sold previously are up here, right? And so you actually have very little risk because they're going to appraise very easily for something that when you look in the rear view mirror. So those are important things to know. And that's also some of the opportunities, right? Buying with less money down. There are many options. You can buy up to $2 million home right now for 10% down. That's not a new thing, by the way. It's always there. It's just now it can actually win because you're not dealing with multiple buyers and competition. We also have seen more creative financing strategies that are now there that were not there before. So for example, people are not familiar with adjustable rate mortgages. Now, this is not the same as it was back in 2008. 2008 arms were terrible because that was a 1-year fix. That's called shenanigans, because then every year it could get all messed up, and then now you're all of a sudden can't afford things. These arms are 5-year, 7-year, 10-year locks, right? And then after that, that following year, it can only increase by up to 2%. There's a max of it, right? So there's much more guidelines than it was through the crazy stuff that happened in 2008. But the idea is that's a very logical and a lot of very popular option, because most people are betting that after 5 years, I don't think we're going to have rates this high for that long. Now, that's a very viable option. Then why go out a 30-year fix right now? If it does drop, you can always refinance it, or you can refinance into a 30-year fix if you choose to do so. There's the other one, which is a very more recent one, which is called a 2-1 buy down. That is actually where you still qualify for the mortgage rate of whatever it would be, but the lender is now subsidizing it. Whereas your first year, it'll help with your monthly amounts because you're having less to go under, and then the second year will also be reduced, and then the third year it goes back to whatever the rate would be. Right, so that's a very popular, and I like to share that a lot more because it's a good option to help people get through the next 2 years, and then from there decide what to do. And the last but not least, the ability to ask sellers for recovering costs is now applicable. So all those repair work that you saw in the past that you had to spend $10,000, $20,000, $30,000, $40,000, you have to take care of that in the past yourself with your own cash. Now that is different. Now you can ask them to get these things done. You can also just ask them anyways, because that can then be used to lower your down payment. It can also be used for you to buy down your interest rate. So whatever you see being marked as, you can always buy down the rate if you wanted to do that, right? So those are all available options. And so those are all the opportunities that were not even there to even consider pre-April, because no one's going to do that for you. It's too competitive. It's all about competition. So some quick tips before we wrap up. Lower your burn immediately, right? If you're going to be thinking about buying, just stop paying for those luxury rentals. I know you enjoy paying those $4,000 to $6,000 a month rentals. Stop doing that. Save money. Share a room. Save money. You can easily accrue a lot of your down payment very, very quickly. You can potentially pull your resources. It doesn't hurt to save more money, get help from friends and family, ask around, help. Maybe they can, if you're paying mortgage at 5 to 6%, maybe you have some deal with them. You give them 3 or 4% a year. It's a win for you. It's not a bad thing for them, right? Their savings account is not 3 to 4%. So there's different opportunities for you to strike there. If you're a little bit further out because you have literally no money to save, that's where you keep working on your credit score, improve upon that, get that as high as possible. And don't do anything crazy. Do not buy anything fancy. Don't buy any large items like brand new cars, new leases. I'm like, oh my God, I have some clients that just bought a brand new Tesla, brand new car, and they're like, I can't afford to buy a house. I'm like, you do not need to buy this car at this time. What are you doing? What are you doing? So those are just some tips. Last but not least, last slide, and then we'll answer any questions and we'll wrap up, is let's just connect. Right? At the end of the day, everybody has a different situation. Many of you on this call I've already talked to, and I look forward to work with you. We can go over the game plan if we haven't already. The very important thing, though, is to get pre-qualified for a loan, to just understand what your options are. Higher rates does not mean all of a sudden you cannot buy, right? Rates from 3 to 6 does not mean your budget is cut in 50%. That's not how math works. It's a variable that gets calculated in a way you can afford. A 2%, 3% increase in interest rates is equivalent to like a 20%, 25% delta in terms of affordability, what can be done before. As you can see, fortunately, prices have declined and you have less competition. So there are a lot of options still readily available. It's all a math equation. You want to understand that, and then you can start looking. From there, then you know what are options that could work, right? We'll go over this together. For budget is X, million, 2 million, 3 million, whatever it may be. Every area will still have its band of prices. We will then make sure you're looking in the right areas to consider. And the last but not least, this is a time, case by case, that we can be more aggressive with buying things at a discount, asking for seller credits, and just being more aggressive. And this is a very, very rare opportunity to do that. First time in the last 4 years, really, to be able to do this. We had a little bit of a stint in 2019, but now it's a good opportunity for that to happen. for many properties. Okay. Love to open up. If you have any questions, you can feel free to unmute yourself. Feel free to type in the chat. We can hold on. I can do this for a couple of minutes and then we will wrap up the evening.
Since nobody else wants to jump in, I'll go for it.
Go for it.
I think under the Trump administration, there was a limit to the amount of interest deduction you can take per year, right? They're like 75 grand or something right now, or am I totally mistaken on that?
The exact number this is related to like what is the best tax deduction strategy that you want to work with your CPA on. So what you're referring to is we have this thing called SALT tax. So anyone that's looking at it, just Google that up and look at that. There's different guidelines of like, should we do this as an itemized tax deduction? Should we have it as that? So a lot of people mistakenly, to be fair, they thought, oh my God, that's going to kill the coast markets because nobody's going to want to buy a home over $1 million anymore, because that's what it really penalized, right? It's like homes over $1 million because in the past, you can deduct all your mortgage interest. Now you can only deduct up to X amount. That all of a sudden all expensive markets would be killed, which was clearly not the case. But yes, that is a material thing. I would suggest it because that's more tax related. You can weigh over the options of like, what exactly can I deduct up to? I believe it's actually $750,000 in terms of the mortgage amount, not 75,000. I don't know what the 75,000 is. It's 750,000 for the mortgage side, and then there's like some interest of how much you can deduct and things like that. And then you weigh like, does it make sense to do standardized deduction or itemized? But that's a complete tax question now.
Okay, so we don't know what that limit is. I mean, what's the variables on that, or should I just Google it?
I would say Google it. State and local tax, okay. SALT tax, Trump SALT tax. It's called SALT tax, state and local tax. And then I believe it's like 750,000 in terms of the mortgage size limits. And then, but then there's a tax question of, do you leverage that or do you leverage the standard one? And there's other variables outside of housing of your own situation that you would have to figure out.
Okay.
Anyone have any other questions or thoughts?
One more for me is that I really appreciate the rent versus buy calculator. It's conceivable that such things exist out there, but I didn't really think that I didn't think to search for them. But as soon as you mentioned it, I did. And it's really looking like I'm going to be renting for a very long time. It's
all about also what you put in those assumptions.
And that's I know. And that's what turned it into rent for a very long time.
Then it makes sense for you, or at least from a potential finance perspective, that may make sense for you. Yeah, like I mean, home buying is not for everyone.
Yeah, I mean, the huge variable for me is the appreciation of the value of the house. If I put in what Zillow says is happening in my zip code, then it says, oh, sure, I should have bought 2 years ago. But if I leave it as the default, then it says, yeah, you're going to be renting forever. So it's kind of banking on housing value increasing the way it has historically in my area.
What did you put in then for that? 0?
No, it was, I think the one at TechCrunch or whatever, the same one you took the screenshot image from, or NerdWallet, sorry, that was it. That actually had a default of like 3% in it. And I live in Pleasanton, which historically is about like 10 to 12. So if it really is 10 to 12.
It's not 10 to 12. It may be 10 to 12. So it's not 10 to 12 for sure. So that's a wrong assumption. It's 10 to 12 if you look at like pre-COVID, which is not a number that you want to use anyways. That number that I gave it, the 5 to 7%, is over decades, over 30, 40 years.
I know. So, and I'm going by, I mean, Zillow sends me I have a monthly thing that says for your zip code, here's the average cost of a house 1 year ago, here's the average cost of a house today, and it is consistently above 10%.
Right, because they look at their most recent few years.
Yes, as in it's looking at the year over year 12-month rate.
Yes, That's what I'm exactly sharing. That's looking at the most recent times. But so I wouldn't use any of those numbers either. And that's why I didn't give you those numbers. In the last 10 years, it's been 10% increase on average. So yours is not like extreme one way or another. If you look at 10 years, the number that I gave is of 3 or 4 decades. So the fact that you use like a lower number, like I think you said 3%,
That would fall, yeah.
it's a very conservative number relative to history. But it's your choice. If you play around with that number, if you want to use actually something of history of like 5 to 7%, then you can see like where does the breakdown work. And then also, to be fair, you also want to put in what has the rent figure is. People have been very conservative of what rent figures have traditionally been because of what's been going on. You can just read the reports all over that the rent figures have been pretty substantial in terms of that. So that's the thing, that's the problem with these rent calculators, right? Because you can be very conservative and it's going to be very skewed one way or the other. There's also general baselines for both. And then there is a crossing point. That's just what it is.
Hey, I have a question about how many offers have you seen for deals, for sales?
Yeah, it's a good question. So at the end of the day, it's all case by case about it. I mean, the fact is this, and this is the thing that I always teach everybody, is none of us here control how an agent wants to list a home, right? We don't. So if everything in a neighborhood is selling for $3 million, right, and they list that home for 2.8, you should expect, and it should be reasonable. Is it very reasonable? There should be a good amount of offers, but that doesn't mean much, right? Because they did it low on purpose. Now the caveat is if they list that same home for $3 million today, and all those other homes sold for $3 million in the last 1 or 2 months, you may just get a few, or maybe 1 or 2 offers. Nothing crazy. I wouldn't expect it to be much higher price wise. So the question related to number of offers is always case by case, right? And so what I always like to do is I'll always share recent other homes that have sold in the last 1 or 2 months. So you can see for yourself of like, okay, this neighborhood home sold for this. Okay, wow, this was a fake low price. I get why there's a lot of interest. Or, okay, I understand why it's been on the market longer, is maybe overpriced. Maybe they're looking at April numbers, right? And so that's a very important thing, because I don't want to say, oh, there's no offers on any homes, or there's a lot of offers on a lot of homes, because it really does just still depend on like what they want to list it at. But in aggregate, it's less, right? Because if it wasn't, then the market wouldn't be going down. It's not a bidding war, because if there was a real bidding war, prices will be going up, and that's not the case. So that's how it works. All right, that is about it for now. Well, thank you so much for the questions. Thank you so much for tuning in. Of course, my details are here, so call or text me anytime, 408-547-4590. Love to go over a specific strategy call with yourself. I hope it was helpful. And